In this video, I'll tell you top 4 tax write-offs for your business so that you can reduce your tax bill and keep more of your hard-earned money. It's important to pay the right amount of tax, but that also means that you should not pay tax on legitimate business expenses. I'm Kiran and I'm a qualified accountant with over 10 years experience working in tax for some of the leading tax practices in the UK. Just a reminder that this is not tax advice, but it is guidance so that you can go and discuss anything relevant to you with your own accountant. Let's start off by talking about the concept of tax write-offs and the current tax rates. A tax write-off is an expense that you can deduct from revenue to arrive at taxable profit. It's also known as a deductible expense. And not every cost in your P&L is deductible for tax purposes. So that's why often the profit before tax in your P&L is different to the taxable profit number in your tax return. For example, client entertaining is a common expense for a lot of businesses, but it's not a deductible expense for tax purposes, so it's added back before reaching your taxable profit figure. For trading companies, deductible expenses are revenue expenses incurred wholly and exclusively for the purposes of the trade. And if you're doing business in the UK, then you are most likely operating your trade as either a sole trader or a limited company. As a reminder, the self-employed pay income tax and national insurance contributions on their profits, the same way an employee pays these taxes on their salary. If you have a limited company, you will pay corporation tax between 19% and 25% depending on the level of profit that your company makes. Now let's talk about the first tax write-off, which is capital expenditure. It's likely that your business will make some large purchases. It could be for laptops, computers, or furniture. But these costs are not deductible from revenue for tax purposes. These are examples of capital expenditure or Capex, for which HMRC has a different type of relief available called capital allowances. Capital allowances are often underclaimed by businesses, which means that tax savings are available but are not always being used. There's no single test that will tell you if expenditure is capital or revenue. So instead, HMRC uses a series of criteria. For instance, they will look at whether the expenditure has resulted in you acquiring an asset and whether that asset provides enduring benefit to the business. And if it does, it's likely to be capital rather than revenue expenditure. So let's say that you bought a laptop for £1,000 for use in your business. That would typically be capital expenditure and you wouldn't be able to deduct the cost of that from your revenue, but you would be able to claim capital allowances on it. Capital allowances are typically available at a writing down allowance of either 18% or 6% depending on the nature of the asset. But the UK has very generous capital allowances rules. We have the annual investment allowance or the AIA and also the new fully expensing rules. That means that sometimes the full cost of the asset can be written off in the year that it was bought. So if the laptop qualified for AIA and your company paid a corporation tax rate of 25%, you would have a £250 tax saving in the year that you bought the laptop. Capital allowances are available to both companies and sole traders, and to make sure that you're benefiting from them in full, you should track your expenditure on capital items and then check whether or not you qualify for capital allowances. Number 2, electric cars. You can claim capital allowances on cars that you buy and use in your business. But cars don't qualify for the AIA that we just spoke about. However, capital allowances on electric cars are very generous because you can use enhanced capital allowances which allow you to write off the full cost of the car in the year that you purchase it. That's very generous compared to normal capital allowances on petrol cars and diesel cars because they will only qualify for writing down allowances of 18% or 6% depending on their level of CO2 emissions. So if you bought a brand new Tesla for 50k in your business, you would be able to write off the full cost of that car through your business. And if you were paying corporation tax at 25%, that would be a tax saving of 12.5k. Of course, you still need to pay for the Tesla, and that will be an outlay for your business. But it means that if you need a new car for your business, it could be a good option for you to buy an electric car through your business. And so it's definitely worth keeping in mind that tax saving when you evaluate your options for your new car. But just remember that if you do buy a car through your company and you use it for private use, then it will become a benefit in kind, which means that income tax will be payable on that benefit. And that will be calculated using the taxable value of the car, the CO2 emissions of the car, and the tax bracket that you fall into as an individual. But it's worth saying that for electric cars, the benefit in kind charge is minimal. Sole traders can also claim capital allowances on cars, and the benefit in kind charge is not relevant to sole traders because they don't have the separate legal entity of the company buying the car. They're just essentially buying the car themselves. The third tax write-off is home office expenses. If you run your business from home, then you can claim tax relief for some of your household expenses that relate to your business. For things like business phone calls, utilities, and business rates, there are two different ways that you can claim tax relief. The first one is using HMRC rates, and the second one is by claiming your actual expenditure. So for the first one, if you are a limited company, you can claim using HMRC's guideline amount of £6 a week or £26 a month. That means that you could claim £312 a year as a tax deductible expense in your company. And it's very straightforward because you don't need to do anything to claim it. You can just put it through your tax return and you don't need to keep any invoices or receipts. If you're a sole trader, you can do something similar, but instead of the guideline amount, you would use HMRC's flat rate. And that's based on the amount of time that you spend working on your business from home. So for example, if you spend 25 hours a month working on your business, you can claim £10 a month back, which would be £120 in your tax return. The other way to claim back these costs is by using your actual expenses, and you would do this if you felt that your expenditure was higher than HMRC's rates. But to do this, you would need to apportion your household expenses between business use and personal use and only claim back the business element. You would also need to keep any invoices and receipts, because whilst you wouldn't send these to HMRC with your tax return, you would need to have them as backing in case HMRC raised any questions into your tax return. But then something a lot of people don't realise is that you can claim back rent and mortgage interest through your business. If you're a sole trader, HMRC just ask that you find a reasonable way to apportion your rent or mortgage interest between private and business use. But for companies, it's a little bit more onerous because you will need to have in place a formal rental agreement between yourself and your limited company in order to deduct any of your rent or mortgage interest through your company. The fourth write-off is miscellaneous expenses. Let's run through a list of miscellaneous expenses that any small business is likely to incur, but you may not know are tax deductible. The first one is petrol costs and parking costs for any business travel that you do, but that doesn't apply traveling to your own office. Any professional subscriptions are also tax deductible, so that commonly includes professional magazines. Advertising is also tax deductible, whether that's traditional advertising or advertising through social media like Facebook or Instagram, and any contractor fees. So if you use sites like Upwork and Fiverr to find people to do one-off tasks for your business, they will be tax deductible. There are lots of other tax deductible expenses that we could cover, but we would be here all day. These are just some of the ones that will be more relevant to small businesses and that often get missed. If this video was helpful, then check out the video linked on the screen where I talk about important tax updates to the UK tax system in 2024 and 2025. Please subscribe to the channel if you haven't already, and I'll see you next week.